Hello and welcome to RC Truth Media. Today we are going to read a couple of articles from ZeroHedge addressing the dollar problems, the economy, our relationships across the world, with China in particular, and what is coming. Change is coming for the world. Let's go ahead and discuss these two articles. The first one comes to us from ZeroHedge, is titled "The Worst Case Scenario: A 10% Tariff on All U.S. Imports and Exports Would Slash the S&P EPS by 11%." Over the weekend, Goldman made a material change in its analysis of the U.S.-China trade war, which it no longer sees as simply a negotiating tactic for Trump to extract further concessions from Beijing, but as a policy which is set to go live on July 6th and now comprises Goldman's base case, to wit. With this announcement, the likelihood of tariffs on the first 34 billion in goods rises substantially, and implementation by the July 6th deadline looks like the base case. That said, there is still a clear possibility that tariffs could be postponed if U.S.-China negotiations in the interim are productive. If the tariffs take effect on schedule, we expect China to retaliate with tariffs on a previously announced list of U.S. products. Of course, the risk is that once this tit-for-tat regime begins, it may continue escalating indefinitely. Recall that on Friday, in order to prevent China from retaliating to the first $50 billion in tariffs, Reuters reported that the U.S. may impose higher tariffs on an additional $100 billion of Chinese imports. This threat did nothing to slow down Beijing's response, however, which retaliated almost immediately with $50 billion of its own tariffs. Clearly, if implemented in about 60 days, this second round of trade war will likely be much more damaging for both sides. Commenting on the potential escalation, Deutsche Bank economists said that the second U.S. tariffs list could include the big item consumer goods such as phones, computers, TVs, etc., which could mean a lot more workers in China and U.S. consumers would be negatively affected. If this second scenario eventuates, the German bank expects China to loosen policy, such as tolerating the property and land market boom in Tier 3 cities and cutting the RRR twice over the rest of this year to partly offset the potential drags. Keep in mind that even without trade war, last week we learned that China's economy just reportedly shockingly weak data, which prompted the PBOC not to hike interest rates alongside the Fed. Okay, well, we actually don't believe that data, and they don't want to increase interest rates because it's not the best thing to do. They're increasing their liquidity in China, so there's no way they would want to raise their interest rates. Okay, so for here, we're decreasing our liquidity, meaning we're not allowing the credit like we used to, like we have been in the past 10 years, which I don't think we should have let credit get borrowed at near 0% interest rates for that long anyway. Look what it did to the debt, the national debt, 20 trillion. Okay, so we go down, see if this article has anything more to say. But the biggest risk is that neither of the U.S. nor China is so far willing to indicate of a potential out to this classical tit-for-tat escalation, which in turn means that the risk of an all-out trade war, one which expands beyond merely the U.S. and China, is growing. As a result of escalating trade war concerns, Barclays recently estimated the impact in the worst-case scenario of an all-out trade war for the U.S. companies across sectors and U.S. trading partners. In a nutshell, the bank calculated that an across-the-board tariff of 10% on all U.S. imports and exports would lower 2018 EPS for the S&P 500 companies by negative 11%, and thus completely offset the positive fiscal stimulus from tax reform. Furthermore, the impact on exporters, which would be directly affected, would be 5%, while that on U.S. companies that import finishing goods or inputs would be higher at roughly 6%. This, to Barclays, highlights the unintended consequences of imposing tariffs given the global nature of current supply chains. As part of its analysis, summarized in the chart below, Barclay finds that the impact of tariffs varies substantially across sectors, which industrials being particularly vulnerable, and although technology companies have a large amount of foreign revenue, they would not be directly impacted because this revenue is attributed to their foreign subsidiaries. The impact on the energy sector is large, but that is mostly because of exposure to trade with NAFTA. So let's look at the impact on tariffs. They vary across all sectors. Okay, and it's looking like this is doing more of a negative impact on us so far than it is China. But, what are we going to do? Are we going to continue letting China collect $500 billion from us every year? Because that's how much we're going into debt. It's from China. Okay, it's not like we're actually paying them that $500 billion a year, but we're going into debt $500 billion a year with China, which totally screws up the faith of our currency all across the world. Okay, the more we get into debt, the more these nations across the world do not trust us. Let's go to the second article I wanted to show you, also from ZeroHedge. And this one is from Douche Bank. I like calling them douche bank because they're really douchebags. They've done a lot of bad stuff over the years. Okay, Deutsche Bank. This is the most dangerous development the Fed wants to avoid. In the first week of February, in the trading session just before February 5th, VIX termination, the market tumbled as a result of January average hourly earnings number that surged. Even though, as we explained at the time, the market had widely misinterpreted the print, promptly speculation that the Fed was dangerously behind the curve and would need to accelerate its tightening, potentially hiking rates more than just 4 times in 2018, leading to an accelerating liquidation of risk assets, would eventually culminate in the record VIX spike. Okay. Since then, inflation fears moderated following several downward revisions, as expected, and more tame hourly earnings prints, with market concerns instead shifting to trade wars, the return of populism to Europe, the tech bubble, and the sustainability of record margins and net income. But according to a recent analysis by Deutsche Bank, traders are ignoring the risk of an imminent phase shift spike in wages at their own risk. Specifically, Kokett looks at the current locus of the Phillips curve, which many economists have left nor dead due to its seeming failure to explain how the plunge in unemployment to record low levels has failed to boost wages, and notes that as the economy approaches the full employment, wages tend to become more responsive. This, to the Deutsche Bank analysis, is the inflection point that the Fed is monitoring. Looking at the Phillips curve over the past 4 economic cycles, Kokett compares it to the Cheshire Cat's smile from Alice in Wonderland, which is present even when the actual cat body is no longer there. In each cycle, it falls apart, but after every annihilation, it recomposes itself and continues to play an important role. Specifically, what Kokett highlights is the sudden phase transitions between the end of one cycle and the start of another, in which one observes a near vertical spike in inflation to the smallest favorable change in underlying conditions. In the DB chart below, each cycle has a different color, which implicitly marks their beginning and end. Okay, so we could see from 2017, this has been rather flat and getting lower. Okay, something that is not normal. Of course, as economists have long lamented, what has prompted many to speculate that the Phillips curve is broken or even dead is the failure of the economy to respond with a sharp increase in wages to the already near record low unemployment rate, which is over 0.5%, below what the Fed currently believes is the NARU, non-accelerating inflation rate of unemployment, or the unemployment rate which does not cause inflation to rise or decrease. The NARU level corresponding to 1990 is 6% and 5% in 2000 and 2006. Currently, it's around 4.5%. This is the territory where the Fed is likely to become concerned. Allowing the economy to overheat would jeopardize the Fed's ability to control inflation if it rises too fast. This is where hyperinflation comes in. Okay, interest rates are going to be too high. As I had noted and stated from earlier, they plan on rising interest rates for at least 4 more times in 2018, and in 2019 it's planned to raise interest rates a few more times again. So what happens when we raise interest rates? Liquidity becomes less. Okay, so that means people, it's going to cost more in order to get credit. It's going to cost more to borrow. That's basically what this means. Okay, so the borrowing market is going to go flat. That's what's going to happen. People aren't going to be allowed to borrow. What's that going to mean? The economy is not going to go anywhere because inflation's going to hit, which is going to make the value of our money be less and less and less. And then also, we're not going to be able to borrow money. At the same time, it's going to cost more money to borrow money. What's that going to do to the dollar? What's it going to do, guys? Answer the question. It's going to make hyperinflation happen. Now, this will set in within the next couple of years, and I believe this is what Trump wants to happen. He knows that the dollar is dead, and I believe he's trying to accelerate this in order to get us into the new system. The National Security Association, the NSA, and look this up if you don't believe me, they were the ones who made up Bitcoin, digital currency, okay? Go look it up. It's in the 1996 white paper that the National Security Agency had published. I'm sorry, I said National Security Association earlier. It's agency. Now, they published this white paper in 96 talking about the creation of cryptocurrencies, okay, because they had knew that the dollar was done and they needed to switch over into a new system. Now, I believe that Mr. Trump, President Trump, knows this, and what he's doing is he's cutting off all the bad deals overseas. He's engaging us in some new deals relationships, and he's accelerating the death of the dollar and the Federal Reserve. Okay, he has a picture of President Jackson, which is the one who wanted to take down the Fed, in the office right now. And there's a reason he's got a picture of that president hanging up in his office. Okay, I believe he wants to take out the Fed and bring in the new system. And we're going to see this take out, especially as we enter and we are in the grand solar minimum, okay, which is going to make trade hard to do with the dollar system across seas because everything's going to freeze up, and the crypto system will be perfect for this. I hope you guys got something out of coming to the channel today. Thanks a lot. Please like and subscribe. I will leave a link below where you can donate through PayPal. You guys have a very, very nice day, and I will see you again later with another truth video.